Hey, welcome everybody. This to NAAIM Confidential, episode 19. I'm this week's host, Ryan Redfern. Today we have Chad Karnes, CMT, from here in Austin, Texas. Great to have him here. I've known him quite some time. He was actually one of my CMT sponsors, so thank you for being here. Those who know me know I always try to get the CMTs on mine because I like to be more of a technical, chart-focused event. So thanks, Chad, for being here. Let's
Yeah,
start off
thanks for
with
having me.
the NAAIM sentiment, or sorry, NAAIM exposure index. Let me share my screen. Boom. It was down a little bit this week, which I thought was funny because on my reporting I went up. So I'm curious, Chad, what did you change this? You're a
Uh,
contributor, right?
yes. Yeah, this week I was flat and levered long.
Okay.
So I didn't change my exposure, but yeah, so I run a trend following strategy
Mhm.
using levered ETFs. So it's pretty easy for me to know if I'm levered or not
Right.
in the exposure index. So usually I'm either fully levered long or fully levered short because I use levered ETFs in
Oh,
that
okay.
way. So I'm levered long, and this week it worked out. We'll see what happens next week.
Yeah, yeah. So you were way above that 89 number. You probably reported 200 then.
Yes, yeah, I went to plus 200. There's times I'll be hedged and I'll be
Yeah,
a plus 100 or a minus 100 or zero even, but generally I'm usually either plus 200 or minus 200.
right, right. No, I'm more in the slower to move, but I reported 120 this week. So yeah, I'm kind of intrigued that it went down when the two of us were like, no, I'm way more in this week and had a good week for it. So
Yeah, it'd be
nice.
interesting if you know how the futures markets do you're a commercial or you're a small trader or it'd be interesting if we were able to kind of parse the data to the next level of what kind of strategy is
Yeah,
reporting what.
yeah.
We might find some answers there where trend followers maybe got all along, but maybe it's mean reversion or value or something that came in lower.
Yeah. Well, I think the hope of it was to have a broad array of strategies. So we don't really know what they are, but everything
Yeah.
from there are several that are almost like buy and hold. They're not far from buy and hold that report the same number like for weeks and weeks and weeks, if not months. So it's you and I that are really pushing the needle up and down.
Yeah, my average turnover is every 20 days. So
Right, right. Yeah. So
I'm,
definitely,
I'm,
definitely
I'm
that's on
updating
us,
it
I guess.
constantly.
Up
Yeah.
to us to make that thing move. So
Yeah.
do you
I,
ever
I, I really like that kind of index. I've known about that sentiment index for a long time, even before I was a named member. And
Mhm,
there's a few other ones out there that I would follow.
mhm.
And generally it's a fairly good contrarian indicator,
Yeah.
right? In a
It
way.
actually is. Yeah.
So, the tops are happening, when we're the most bullish, just like the general market, and the bottoms are happening when we're the most bearish, just like the general market.
Right, right. And even I think Rob Hanna did a survey on it, and when the market's trending up and the sentiment index pulls down below 60, like in the 40 to 60, that mid quintile range, it's a great time to buy for the next 5 days.
Is that kind of like a trend indicator, a momentum indicator, like an RSI pulling back to the 40 to 60 range
Basically, yeah, is how
in
he
the
how he
market?
he found it was useful. So
Yeah. Huh.
yeah, and even bigger swings if it pulls down into the 2040, but it's less likely to be profitable. He has a whole study on it. I can send it to you if you want to see it. It's
Yeah.
I think he
That's, I
he had an
mean,
episode on here where he showed it, and that's one of the things he was looking at. So,
well, that's one of the benefits of joining something like NAME, right? You get
yeah,
to share, knowledge with like-minded and smart people.
absolutely, absolutely. Now there's a lot of good people like that in this group. So yeah, so let's dive into what your market philosophy is. If you want to go ahead and share, I know you got some slides that we can flip through to
Yeah, let
have a
me let me share my
discussion about
screen
it.
here.
Sure.
Yeah, I just put something together. It's not going to be fancy, but at least it keeps us on track and kind of has something people can look at
Yeah.
while we're talking here. So my market philosophy, I thought about this. It's more of a general life philosophy. Sleep well at night.
Mhm.
So
Right.
so you want to, like, from the market's perspective, you want to have a strategy that fits your personality, that that makes you feel confident and comfortable, and thus I call it sleeping well at night. And so for me, I've kind of got 4 bullet points here with kind of the final general overall philosophy. But for me, it's having a rules-based strategy. So if you're able to create something that has rules, then by definition, you should be able to back test it and you should be able to, put it to the test, so to speak. And then with that, get results that are more believable. The less subjectivity into something and the more objectivity, the more you should be able to trust it as fact versus opinion or fiction, right? And so, step two on this is having a system or process, which step three allows for the back testing of a strategy, which creates more trust and confidence. And if you have trust and confidence, then you're able to sleep better. So that's kind of my philosophy is try to figure something out that you can rely on and lean on. So you're not ultimately not trying to guess, and you have something that has a little bit more meat than just an opinion. So that's kind of how I've designed kind of my investment philosophy and some of my strategies, is try to get as much of the bias out as I can.
Sure, sure. And I think we're going to dive into some of that as well, because I was going to ask you, so how do you go about testing and what do you look at? And I think you've got more.
Yeah, well, so first I was thinking about this. I think so I'm a CMT, like you mentioned, just like yourself, and I run the Austin chapter of the Market Technicians Association. That association has changed a little bit since COVID. We used to do a lot of in-person meetings prior to COVID, and now it's become a little bit more virtual. But going through that CMT process, I continue to look back and think about my time studying for it and kind of why I went down that route and what I got from it. And like this next slide, I'll kind of talk a little bit. You can see this, right?
Yep.
Maybe I'll just make it bigger. Just a second.
Oh yeah, yeah. You should make it full screen.
Yeah.
There you go.
Okay. So one of the things I originally got out of the CMT was just to think differently about the markets. So not unlike a lot of people that are probably members of the NAAIM or interested in the markets, I went to school and got a finance degree. And in that finance degree, there was very little, if any, talk about technical analysis. But I happened to be going into college at the turn of the century when you had the dot-com bubble and then bust. And there's a lot of things that were happening there. And, obviously when you're in that time period, you're not really thinking about it this way, but looking back, the internet had just started. People were literally just getting their first brokerage accounts and learning how to use the internet and build websites, et cetera, and trade online. And, when I'm in school, that's going on. And then, but then you've also got all your traditional finance, your fundamental analysis, with that, so you're kind of, you're sitting there getting your finance degree and you're learning all your basics and all the stuff that everyone else learns. But then you're looking at this stock market and going, what the heck is going on here? You've got, high flying stocks and you've got crashes, things are down 95%, et cetera. There's a gap there. There's something missing, something that the textbooks aren't teaching us, or something that just leaves a lot to be desired. And so that's what led me down kind of the technical analysis route in college. And with that was the CMT shortly afterwards. And one of the things I like to point out that I learned through the CMT is ratio charting. And I point that out because it's fairly simple. The ratio is just a division. And so I'll skip ahead to one slide and just show the S&P, the SPY, which is.
Well, I'm still looking at your PowerPoint, the tabs on there, not the presentation side.
Oh, interesting.
It's zoomed in, but yeah.
Okay. Let me do it. Thanks for telling me. Let me see if I can share.
Yeah. So before you dive in too far, you zoomed in, but then it's just the.
I think because I went. Is that better?
Now it is. Yes.
Yeah. Okay. Yeah. So I went to full screen and then Zoom didn't pick it up. So sorry about that, everybody.
No problem.
So this is a chart of the SPY, and so the thing I think about the CMT, it opened my mind and allowed me to think about things differently. So the SPY is the S&P 500 equivalent ETF. But what really is it? It's actually a ratio. It's actually the S&P 500 divided by 1. And what is that 1? The 1 is $1. So going through the CMT process, some of the books I read and work I saw, started looking at ratio charts and showing me, well, look, you don't have to just measure things in dollars. You can measure the SPY in euros, or as I have here, in gold. So, you don't just have to think of things in dollar terms. And in fact, when you start thinking outside the box like that, it opens your eyes a little bit. So this chart here that I have is a perfect example. The S&P has made countless new all-time highs, but has it? Well, it has in dollars.
Right.
But if you start measuring it in other things like gold, it's 30% below its high back in 1999 still. So if you want to sit here and say, potentially that maybe the SPY is going up because the dollar is going down, right? And that's why gold is going up. Possibly, it's that's not a factual statement necessarily, but it's now a possibility because you've now just turned this chart upside down, so to speak, and started looking at things a little differently. Another one, yeah. So this chart here, the SPY versus gold, is really eye-opening, I think, because if people, especially today, where people start talking about, well, we're spending too much money, we have too much debt, interest rates are getting out of control, yada yada yada. Well, this SPY versus gold chart supports that in some ways, and maybe one reason why gold is going up so much faster than even the SPY over a 30-year period or 25 years. So one more chart like that, the Nikkei. The Nikkei's testing and just made new all-time highs after forever, back in 1989.
Right.
In dollar terms. Look at the bottom chart. The Nikkei in gold terms is dead in the water still. So off to the right, I have kind of the math, right? So you can have your index, so to speak, go up one of two ways. The numerator can go up, or the denominator can go down. And I like to tell people, cocktail parties, whatever, like talking about the Dow, whatever. Oh, the Dow's at 40,000, whatever. I'm like, the Dow could go to 1 million tomorrow. You want to know how? Just take the dollar down by 100% or 0.999%.
Right.
And that's the math I have here on the bottom right. 10 divided by 5 equals 2, but 10 divided by 2 equals 5. So you haven't changed the numerator at all.
Yep.
So maybe the numerator is the S&P, but you've changed the denominator. And so that's one of the things the CMT kind of helped open my eyes to start thinking about, just think about things differently. And the stuff that you learn in school and in college, it's not necessarily factual. There's a lot of gray area in finance. And I think, when I was a bright-eyed, wide-eyed, 20-year-old in college, everything your professor's telling you think is gospel, but the reality is there's a lot more gray to it than you would have ever been led to believe. And then the CMT process for me helped think outside the box more.
Right. And you've actually taught some of this stuff at Texas A&M here, if I'm not mistaken, right?
Yeah. So and I did a webinar for NAAIM a couple months ago around trend following. And here's a chart. This is one of the charts from that presentation. And really, this is another kind of thinking outside the box. Your average person may pull up a chart, from whatever website, CNBC or Robinhood or whatever, and look at that chart. And 99.9% of people are going to pull up a standard chart, which has time on one axis and price on the other axis. But it doesn't have to be that way. There's plenty of other ways to look at the stock market and look at charts of the stock market. And what I have here is one of those ways that I look at it, which is a little differently. I take time out of the equation. I use range charts, range bars, which is the bottom portion of this graphic. And you can see just, on this particular slide, and this is kind of the culmination of that presentation, but by using the range chart, I was able to take out essentially a quarter's worth of noise, so to speak, in the price action, in the price history of in this case SPY. So that webinar is on NAAIM's website. You can find it there if you want to dive into it and get a little more detail about kind of this range bar chart and kind of what I call the trouble with trend following and a way that I've kind of tried to get around some of the downsides of using a trend following system.
Oh, for sure. And I copied this since that webinar, and I have a whole chart book in Optima. I think you're an Optima user as well, where you can recreate this very quickly.
Yeah, it's literally just changing it from a candlestick chart to a range chart or whatever.
Yeah. But there are not a lot of softwares that can do it that quickly and easily that I know of. So
That's exactly right. And I've used different softwares. I started using it in TradeStation
mhm,
probably about 15 years ago, and then Bloomberg has one kind of
mhm.
similar option, but it's still not near as good as Optima.
Yeah. No, Optimus, good stuff.
And
And
then
I was going to go back to the A&M thing. I was going to say that gives me hope that on campuses they are teaching technical analysis in some case where so many are still just fundamental only. They really can't get out of that box.
yeah, well, A&M is a perfect example, and I just learned this when I was up there because they actually have a very good program. I forget the name of it, but it's tied deeply into the energy firms in Houston.
Oh, okay.
So they're literally creating jobs for kids out of college to go be traders at these big oil
Yeah.
firms and energy firms. And to be a trader, that's one area of finance I would say that's always had a tilt towards technical analysis, is the trading pits and the ones that are actually executing have used technical analysis for a long time. And so Texas A&M is I'd call it almost cutting edge, because I hadn't heard of other schools that are kind of positioning themselves in that way. I was pleasantly surprised.
Yeah, absolutely. Well, and I always think of the technical analysis as the when, where the fundamentals more the what and the why, but it doesn't tell you when. I mean, something on a value stock can stay low price forever. If the technicals don't back it up, then that's where you find the answer that, oh, I should be buying this as a technical, for me, not a fundamental. I just find I'm not that patient to wait for a fundamental trade to play out. So,
Right. I don't think any fundamentalist would ever say that, you can time the market, but
mhm.
plenty of technical analysts would say that you can time the market.
Exactly. You spend enough time in this world, you're like, oh yeah, you can. There are things that you can do.
Yeah, right. And that just goes back to the academia and whatnot. I mean, there's plenty of research out there now that's proven that momentum and some other technical analysis kind of philosophies do work.
Oh, absolutely. And the CMT program covers a lot of that, and momentum is definitely a big one. Even seasonality is actually a pretty solid uh, practice as well, which is a little bit not exactly CMT, but they do cover it a bit. I find there's a lot of value to looking at that sort of that angle of seasonality and like certain times of the year, certain months of the whatever, but certain things work better in certain times, which is fascinating. Then you pair that with the technicals, and it's like, oh, that's worth checking out.
Well, yeah, and go back to the name index, right?
Mhm.
That's call that behavioral finance, right? And kind
Yeah,
of more psychological finance, but in
right.
sentiment, that's more in the technical analyst realm also than,
Mhm.
you're not learning about sentiment analysis in your undergraduate finance class.
Right.
You're
No,
learning about it in the CMT program. And you're probably not even learning about it in the CFA. I'm not a CFA. I don't know. Maybe they've
mhm.
incorporated it since, but
I don't think so. Don't they say like what we do doesn't exist or is impossible, so don't try? I think that's how
yeah.
they write it in the book, right?
Probably, but you've got plenty of people that have both the CFA and the
Yeah.
CMT that I'm sure you could ask,
No,
and
I know many. I know many for
the
sure.
ones that I know, none of them regret getting their CMT either.
No,
In
no.
fact, someone told me the CFA helped them get their job, the CMT helped them keep it.
I can see that. I can see why that would work that way. Absolutely. So you covered your charting techniques. You covered range bars versus traditional bars.
Yeah,
You had one
so
other type there, a
yeah,
macro
so
market
I was
environment.
thinking, yeah, we can
Oh,
maybe
so
just talk a little bit about the current market.
sure.
So one of the things that I mentioned I run a trend following strategy.
Mhm.
And I also mentioned I like to sleep well at night, or at least try to. And
Right.
part of that is making it more systematic, and also just trying to focus on things you can control, right? And so for me, in my strategy, what I know I cannot control is the general market environment. Whether you're
Mhm.
bullish or bearish, or volatility, I firmly believe that volatility is an asset class. And I think that's something that's becoming more and more mainstream, where people are looking at volatility in that way.
Mhm.
But the one thing that I want to look at, for instance, is and I know from a trend following or momentum strategy, when volatility is moving, that's usually better for a trend following or a momentum strategy. When volatility is not moving, it can be not as good of an environment. And so that's exactly what happened in the first quarter. And there's many different ways you can measure this, but one of the ways that I showed my investors was, through the VIX, and just looking at kind of that blue shaded area I have on this chart shows just how little the VIX actually moved the first 3 months of this year.
Oh yeah.
Not only was it below 15 the entire time, it stayed below 15, and then it just barely even moved even below 15. And you can see that kind of the standard deviation is the second section, and then the rate of change is the third section. The standard deviation shows it the best. I mean, it flatlined.
Yeah.
For that first quarter. So that's something I look at and I go, well, and I had a drawdown in the first quarter. And so I can look at this and go, well, that's not surprising at all to me that a trend following strategy would have a drawdown in a period where the VIX and volatility was basically the lowest it's been in 4 years.
Yeah.
And
so the VIX I saw closed today below 12. It's 11.99.
Yeah, and look, I mean, this chart's updated through today or through yesterday, and it's or the 16th. Yeah, that was yesterday. And we haven't been below 12 at all in 5 years. Or this chart shows 3, but it says 4 years. So yeah, another kind of not unprecedented, but just shows you the kind of market environment that we're in right now, which is very low volatility on a realized and a VIX space, which is an implied volatility basis.
Right. This actually makes me think a little bit of the paper that Rob Hanna won the NAAIM paper competition this past year, and it was basically on how to trade the VIX by using the S&P, because most people think about trading the S&P using the VIX, but he actually found that it's almost more valuable to do it the other way. I just thought that was an interesting insight. I don't know if you read that paper.
I haven't, no, but that would be right up in the alley of what I should read. So I'm glad you mentioned that.
I'll send it to you. And he is presenting next month on the regular NAAIM webinar. I don't remember what the date is.
Okay, he's presenting that.
He's presenting that. Yeah. He presented it in Florida at the conference, and then he's going to do it as a webinar as well for people who weren't there. So interesting stuff. I don't know if you follow Rob Hanna and Quantifiable Edges. Interesting.
Yeah,
I've brought him twice in this one. So yeah, he does interesting work.
So I have I'm skipping around a little bit. I have another chart I pulled up that I'll share, kind of back to the ratio charts, if that's okay.
Oh yeah, absolutely.
Share screen. Let's find that.
No, ratio charts are one of my favorite things. And again, from the CMT. I mean, I don't really look at much that's not ratio charts at this point.
Can you see this now?
It's very small, but it is there.
All right, let me see if I can, let me see if I can get a bigger size here. Let's go with is that better?
There you go. Yeah, it's good.
All right, so this is another ratio chart. So without looking at what it is, it's from the year 2000 to today. It's basically the same price, right? You went up, you went down, you went up, you went down, you're back around 4.0. That is the price of home prices compared to a barrel of oil. So using the contracts, the oil contracts. So looking at things differently again, right? Okay, so housing prices have gone up substantially in 25 years, but so has the price of oil. So much so that they're basically gone up the same amount.
Okay.
Right? So you started at around 3.5 times to 4 times, and now you're back at that level. So this takes the dollar completely out of the equation. Because you're comparing two assets that are canceling the dollar out in their denominators. And so that, again, it's like, okay, so what is really going on in the world? And so when I started looking at these, I was just preparing for this yesterday, right? And I started looking at this and just thinking, and I was reading something about the everything bubble. Maybe actually it's not an everything bubble. Maybe it's the opposite. Maybe it's a one anti-bubble, which is the dollar.
Interesting. Oh, that's interesting.
So, maybe the dollar's actually just getting crushed. And we don't see it because it's measured in other currencies usually. And all those currencies are probably also getting crushed.
Mhm.
So if you started looking at gold in the euro or gold in the yen or gold in the dollar, they're probably all looking similarly. And then, so if you start thinking about that and keep going down that train of thought, well, maybe the dollars and currencies are the issue with the way we're measuring all this. And it's hiding potentially a lot.
Wow, that is interesting and something I've never thought of. I'm going to definitely spend some time with that.
Yeah. So, fun with ratio charts, right? And then
Yeah, absolutely. Well, I was going to ask why these two specifically. Were you looking at the home prices?
I picked these two because they're both, I knew that they were on stockcharts.com. They're readily available
Yeah.
tickers. But two, they're both real assets.
Yeah.
So they're both a way to measure, you got housing, which is a lot of stuff, labor, call it maybe not a real asset, but lumber, electrical, plumbing, all that stuff, right? Goes into a house. And then you also have oil, which, you got development, production, shipping, all that stuff in that. But they're both considered real assets and investable assets. So I just use those two because I wanted to try to get something that was a little more, real.
Oh, no, it makes sense. I was more familiar with the Michael Guyad's lumber versus gold ratio.
Yeah. I know what you're talking about, right?
Yeah, and he won the paper years ago with that, and it's definitely worth looking at. Although lately it hasn't been as strong as an indicator, but it's still interesting to look at.
Yeah, exactly. So yeah, he uses a lot of ratio charts. So he's got a treasury one too, right? And
Yep.
and then this is just the SPY again, looking at, instead of the VIX, looking at the, some of the volatility around the SPY. So, so this is the average true range, which is another technical tool to look at volatility. And all that's doing is measuring the high and the low of each day for the prior 14 days and what's the average. And so you can see the first quarter also flatlined.
Yeah.
Basically very little volatility on a realized basis in the S&P.
Yeah, absolutely.
So
yeah,
the real question with volatility as an asset, is it going to stay that way? Or you look at history here and you've got so many ups and downs, right? Just in this 3-year history of volatility. So, I mean, I think you'd be a fool to think that volatility is going to stay low now forever, because there's just there's no basis to think that.
No, and it never does eventually.
Right.
But markets can stay overbought longer than you'd think. I think we're in that place now. But once that stops, then volatility is going to match it. And
that was one of the quotes I thought about. What, I forget who said it, but yeah, maybe Buffett. Like, the market can stay irrational longer than you can stay solvent.
Right. Speaking of, do you have a favorite investment quote? I meant to bring that up at the end here.
I do. I think I need to change the sharing.
Okay.
Back to this. I wouldn't call it my favorite, but we'll put it in the top 5.
Okay.
So Howard Marks over on the right, kind of with the sleep well at night theme, psychological, trying to take the biases out. The biggest investment errors come not from factors that are informational or analytical, but from those that are psychological. So, get something that's more objective than subjective, something that you can back test, something that's got a process and a system around it. And that'll help you take out the psychological potential errors in your strategy.
That's awesome. And that's not one I've seen yet in our webinar series so far on our podcast. So thank you for a new quote that I've not seen.
Yeah, and for those that aren't familiar with Howard Marks, he's got a lot of great ones out there. So you can start Googling, and
we'll do.
He's
check it out.
He's a great person to follow.
Cool. And then to wrap it up, is there a way we can contact you if somebody wants to get in touch with you? Learn some awesomeness about charts, ratio charts, and
right here, email.
Perfect. Absolute Strategies of Finance. Perfect. All right. Well, cool. Well, I think we're just about out of time. So thank you, Chad, for being here today. Great information. Always good to talk to you. We'll hopefully catch up in Austin soon, because we both live here.
Yeah. Thank you for having me.
Absolutely.